When we talk about technical analysis, we cannot avoid to talk about support and resistance, because they are the most used concepts in Forex trading. Before starting, I want to mention that for chart analysis, I'm going to use an online platform that you can access for free. It is TradingView, available at tradingview.com. It's a free online platform, very popular among traders, and it has a cleaner and easier interface compared to the MetaTrader 4. In my trading, I generally use TradingView for chart analysis, and then I open the MetaTrader 4 only to execute my trades. Many other traders that I know do the same, but that doesn't mean you have to do the same. If you prefer analyzing charts on the MetaTrader 4, it's completely fine. Any charting platform is fine, it's just a matter of what you feel comfortable with. So, back to support and resistance. The terms support and resistance were created back in the early 1900s in the stock market and not the Forex market, and the terms are quite self-explanatory. For instance, a support occurs when traders begin buying, supporting a product as its price was falling, and conversely, resistance occurs when traders feel prices are getting too expensive and they resist buying at that price. Let's immediately have an example on the chart. Here we have euro-dollar on a daily time frame, and you can notice that I have drawn two key levels, a support at the bottom and a resistance at the top. What can we say about the support? The price drops to 1.048 several times, but each time it manages to bounce back and change direction. This means that market players feel that 1.048 is a good price to buy euro-dollar, so they start to open their long trades, the demand increases and so the price. What about the resistance we have at the top? The price goes several times to 1.149, but then it stops and changes its direction, starting to go down. This means that market players feel that 1.149 is quite expensive for euro-dollar, so they don't want to buy it at that price. The demand decreases and so the price. Remember, in financial markets, everything rotates around the concept of supply and demand. Now, the first important thing to notice about support and resistance and key levels in general is that they are not exact prices, but rather an area of prices. The price doesn't just reach 1.048 and then immediately bounce back. It may go a bit lower than that, a bit higher than that. It's almost never an exact price. That is why we say it goes around 1.048. Same for the resistance. The price doesn't just go to 1.149 and then magically starts to go down. It may go a bit higher than that, a bit lower, but generally in an area of prices around 1.149. So how do we trade a support? How do we trade a resistance? Well, if you have mastered the key concepts of market structure, rejection and breakout, this will be much easier for you. You want to wait for the price to approach the level of support, wait for it to bounce back and then open a trade to catch the change of direction. Some traders also like to open the trade immediately on the support without waiting for the price to start to change its direction. It's a different style of trading. I prefer waiting for a slight change of direction, that so-called bounce on the support. That gives you a confirmation that we're having a rejection and not a breakout. For the resistance, it is exactly the same. We wait for the price to approach the level, we wait for it to change its direction, and then we catch it with a short position. Easy, right? Well, not completely right, and I feel that this is an important part of the course that you have to bookmark and watch it more than one time, because 99% of the books and courses out there stop here and let you believe that it is actually very easy to make a profit using support and resistance. I fell for it as well when I started trading. It seemed so easy when I was reading books and going through courses. Then when I tried to apply it, I consistently ended up losing money. So was I stupid? No, it just took me years to realize that what we have said so far is just the beginning of understanding support and resistance and other key levels. The hard work has just started for you, and you are still far from being profitable by using the knowledge provided so far. Why is that? Because in trading, understanding the direction of the market is just one step towards being profitable. You also need to understand the entry point, which means when exactly to enter a trade, and the exit point, which means where to place your stop loss and take profit. If we check again this market structure on euro-dollar, at first sight it looks easy to trade, but let's start asking questions. When do we enter the trade? Where do we place stop loss and take profit? For example, if we check a first possible trade here on the support, the price went about 40 pips far from the support level we drew. Is it good enough to open a trade, or should we waited for it to go a bit lower to catch a better price? Of course, we know now that the price went up, so we would have made a profit by taking the trade. But when you are with a live market, you don't know what's going to happen next, and you have to make decisions on a daily basis. Another tricky situation might happen here on the resistance. The price approaches the resistance and it starts to go down, so we want to open a short position. Where do we place stop loss and take profit? You can easily go wrong by placing a stop loss just slightly above the resistance and the price hits it before it goes down. So you can see that despite being right about the direction of the market, because the market ultimately does go down, you lost the trade because you didn't place a good stop loss. So sure, it's nice to see the instructor saying, you buy here, you sell here, you buy back here, you make easy money with support and resistance, but try to do it in real market conditions when you have to decide when to enter, when you have to decide where to place your stop loss and where to place your take profit, and you will immediately notice that it is not so easy. So, is this a problem that is going to stop us from being profitable traders? No, I actually believe that this is what will make you a profitable trader, the acknowledgement that this is not elementary school, and to make money you can't just possibly draw a line on the chart and that's the end of the story. We will need to dig deeper than that and put in the hard work that many other traders out there don't. That is what will ultimately make you a profitable trader. In this lecture, I'm going to share with you the standard way to enter the trade and set your stop loss and take profit. This will build a solid foundation that is needed for what comes next, because as you progress through the course, you will learn more tools of technical analysis that will help you create more sophisticated systems to enter and exit a trade. But all of them are based on the logic I'm going to show you now. We're going to take this support as an example. In this case, the price is reaching the support level, so you can already start to consider buying the currency pair. What we want to do is to wait to see if the price gets rejected before buying it. It might also be that the price breaks through the support level. In that case, we want to consider a short position, but we certainly don't want to open a long position. So before opening a trade, we wait for a confirmation that the support is working and it is rejecting the price. We can draw a blue horizontal line where we can open a long position after the rejection. Now, stop loss and take profit. When we trade with rejections, remember stop loss outside of the market structure and take profit inside the market structure. So a possible stop loss might be here on the red line, and a possible take profit might be here on the green line. Why do we place the stop loss there? The trade is based on the market structure we have identified, with the price going up and down between the support and the resistance. If the price breaks the support and goes down, it means that the market structure has been broken, and so the trade doesn't have a reason to exist anymore. We better close it and minimize the loss. Regarding the take profit, we want to place it at a level that the price often reaches, so inside the market structure in which the price is currently moving. If we placed it, for example, outside of the market structure, so above the resistance, we will need to hope that the price broke the resistance in order to catch our take profits. Remember the golden rule for rejections: stop loss outside the market structure, take profit inside the market structure. In this course, we will focus on trading with rejections, as they are typically easier to handle. Breakouts can be more complicated to trade, because it's easy to see where to place the trade, but not so easy to set stop loss and take profit, as we are out of the previous market structure. I have an advanced course on chart patterns in which I also share how to trade breakouts. This is a beginner's course. My advice is stick with rejections. They don't require a level of expertise and experience that breakouts do. Then, if later on you want to deepen your knowledge on breakouts to add them to your set of weapons to trade the market, feel free to visit the last lecture of the course, where you will find discounts for all the other courses.